Hi guys, welcome back. So, a lot of people are getting really frustrated with the market recently, including myself. Obviously, you see your portfolio getting drained day by day, sometimes slow, sometimes quick. It doesn't feel good. I think the frustration level is getting more and more piled up. So a lot of you would wonder, is it over yet? Is the worst behind us yet? Well, I think this is everybody's question right now, and something I've been trying to figure out for quite some time. Now, I don't have a crystal ball, but so far with what I'm seeing, I think no, the worst is not over yet. I'm sorry to say this. Normally, I would give you a comfort, but honestly, this time, I don't think the worst is over yet because I'm seeing some warning signs, some bad signs that I want to share with you. Throughout the last 2 years, the crazy good bull market we were in, this is really indeed the first time the index can have such a sell-off within not even a month, right? So I think a lot of new investors got in the market after the COVID and had never experienced anything but a bull market. So this is something new. It is surprising and it's hard to take. Yesterday, the Bridgewater, one of the biggest investment fund of US, warns investors that they see much bigger stock drop before US Fed blinks. So Greg Jensen from Bridgewater, the co-chief investment officer, thinks that the S&P can drop as much as 20% more than right now before the Fed is willing to take action, which means the S&P 500 can drop below 3,500, close to where it was before COVID. So last time I compared the three indexes and I also used the level before COVID to be my reference, right? I said the index could be potentially dropping to maybe 20% higher than the peak of before COVID, because I would use this level as a reference and consider the companies in the S&P can be making growth averagely 20% in 2 years. So for the S&P, for example, 20% more than before COVID would be somewhere around 3,900 to 4,000 if we give it a 20% plus. So I would think this is a fair value to correct to squeeze out all the extra foam that was pumped by the QE, right? Now that we don't have the QE anymore, it should correct back to the fair value. And for Nasdaq, I would give it a more growth rate because they consist more technology companies and smaller companies that have higher growth rate. So I would say maybe around 25% average growth since the peak before COVID. And that should give it the target of around 12,300. So my target is around 7% more dropping from here, but Bridgewater just gave a 20% more dropping from here. This is a lot more pessimistic than my target. I thought I was being a little negative on the market, right? But to be fair, founder Ray Dalio, he is kind of famous for pointing out the US bubble and debt crisis many years ago. I think he had been waiting for this big correction for a long time. He thinks it's way overdue, and he had been suggesting investors to diversify into emerging markets, especially China, many years ago. His number one stock position is Alibaba, and other than Alibaba, mostly ETF like the EEM, the Emerging Market Fund. And last year in 2021, with the fall of the Chinese market, he increased a lot of his China position. A little bit of everything, including Alibaba, Baidu, Pinduoduo, Neo, Xiaopeng, everything. Pretty much all the popular stocks of China, he had increased them last year. So he had always been quite bullish on the China economy and the Chinese stocks and pessimistic about the US stocks. So that is the background you need to know. But unfortunately, a lot of investors are new or somewhat new to the market because they only enter the market after COVID. And it's true, ever since the COVID, pretty much every correction, every dip creates good opportunity to buy, and the reward usually is good buying those dips, especially the year of 2020. So this time I think a lot of people think it's gonna be the same, while it's fundamentally not really the same. So fundamentally, this bull market was created by the QE, the pump of unlimited QE, all the money injected in the stock market that gave it such a boost. Because we were under the attack of COVID, there is no way the US government would let the US market crash. While the whole world was in such a big mess, with the pandemic already, there is no room for more mess with an economic crisis. So now the QE is stopping. That means the number one driving force for the index to go only up as the only direction, this is gone. The time has gone. Now it's only the company with the real growth can drive up the index. So we are back to reality. And this process of being back to reality means it needs to correct the valuation. So a few weeks ago, back in December, I started to suggest to keep cash. Even though my long-term positions were at big losses, I still said I trim for tax loss. One is for tax loss realization, and two is because I worry for the last shake when the US market get into a medium-term correction of more than 10 to 20%. And three, because I worry that the growth stocks that I was holding would not relate entirely to the HSI because I thought HSI had bottomed. So if I wanted to catch the wave of the rebound of HSI, I gotta switch to something that has more correlation with the HSI. So those were the three reasons I trimmed my long positions, even though I had to cut such big losses. And if you remember, I have suggested to keep cash. That was in December. I think I was the earliest to point out the correction on YouTube because at that time I didn't see much warning or worry. So right after the Santa Claus rally, after the New Year, on this day, we already had the first bad sign of this danger coming, right? So on that day, I gave the suggestion to manage the portfolio and watch out for the big tech, the previous hot sectors like the FANG and the chip. And I pointed out that Dow Jones or the HSI might be the only thing that's somewhat safe. But I didn't hear many people responding to this. I think people are too used to the fact that every correction would go away and didn't see such a big fall. For me, I speculated a big fall, but I didn't see it that fast. I thought it would drop slowly with rebound in the middle, but this time I didn't see any rebound. For the last 2 weeks, it's more like speeding up to fall. Even yesterday, we had a really strong and nice gap up. Many stocks, especially the growth stocks, were rebounding quite nicely. A lot of stocks were growing like 5 to 10% in the morning. But for some reason, I had a bad feeling. I have a bad intuition that I didn't trust that. So that's why before the market opened, I saw the pre-market up so nicely. I right away notified on the Discord that I would take advantage of the rebound to take profit of the position I bought on Monday during the crazy dip. I sold all the xiaopeng I added on Monday at 37, and I said I would again set up the hedge position, the short position, to protect my portfolio from this upcoming FOMC meeting. So I sold xiaopeng at market open. It was 39.8, the highest it got to, with a strong gap up, right? And then you see what happened after, dropping all the way to 32, near 20% drop in just 2 trading days. This is so scary. It looks like it's not over either. For what I'm seeing, I think xiaopeng would at least need to drop to 30, at least. I hope it doesn't. And same thing with NIO. Every day making a new low, and yet still hasn't found the bottom yet. So that is pretty bad. Even Tesla can drop 11% in one day. How bad is this? And it is after it reports such a good earning yesterday. And look at the short position for the Nasdaq, the SQQQ. This was the time of the FOMC meeting, jump up like crazy. So what did they say with that meeting to make the market drop so much suddenly? I think most of the content is somewhat expected that the market had priced in already. The only thing he might have said is that there is room to increase rates because of the economic environment and the employment rate. And it's possible they would talk about increasing rates every time they have this meeting. So I think that can give the market a bit of scare, but I don't think that's the main cause though. So why did I took profit for other trades yesterday morning and set up the hedge? Was because I think that whatever the Fed would say in that meeting is not the most important in any ways. The short sellers would take action. So this is how I see the situation. I think we zoom on Nasdaq, okay? I think throughout this rally, the short sellers have been waiting for a long time. Now let's make a metaphor. So the short sellers, they are the kidnappers, and their target is the Nasdaq. Why? Because this consists of a lot of the popular stocks for retail investors. The more popular it is for retails, the better, the easier it is to short, and the more money they can make from shorting it. So the kidnapper has Nasdaq to be the target for a while already, but they were too afraid to do it because there was the Fed that was being the bodyguard for this target for at least 2 years, protecting it. So now that the Fed is finally saying that they care more about the other problems more than the stock market, then the kidnappers right away got the message as, okay, the bodyguard is not protecting the target anymore, so I can do whatever I want. So I think the FOMC meeting did not say anything special, but only express their priority not being the stock market. And that is enough for the short sellers to take more actions, because they would take it as a green light. I can do what I want now, finally. So right now, if you wonder why your stocks are falling more than the index, it's probably because they are the popular stocks for retail investors. If you hold any stocks that's not so popular within the retail community, it's probably more stabilized. I think there's a good chance for that. So another risk signal I'm seeing is that it's been going on for more than a year already, that the index are growing, but most of the growth stocks are falling. It's been like this throughout the year of 2021. So what's happening? I think it's not because the big techs are safest or the best company or the only good companies to invest in, and all the other ones are trash. I think it's more like that throughout last year, the index were growing, QQQ were growing, because the big dogs, the big capitals, continue to concentrate their asset into the FANG. They kept pushing up the FANG to create this bull market illusion. So then at the same time, they can exit their positions with the medium to small caps, the growth stocks. Everything that had been hyped up in the year of 2020, they have been exiting while pushing up the index, pushing up the FANG to make people feel like we are still in the bull market, while the bull market had already ended in 2020. And the worst thing it did was that it made so many retail investors frustrated with their growth stock position and change it to the FANG at the peak. So it indeed would help the big dogs to exit their FANG's position. Because I think this was the period last year from November to December where the big dogs were exiting their positions in the FANG, the big techs, the chip, the QQQ stocks. Why? Because now that they have exited most of their growth stocks, they don't need to keep pushing up the index. Now they can set up their short positions to short the index. So this would be the process for the big funds to sell and retail to buy, while the big funds were actually setting up short position. So now most people still think the FANGs are the safest stocks to buy right now at this moment. I disagree. I don't even think they're safe. They are very good companies, no doubt about that. They would last through all these corrections. Most likely will be the winners in the end. But their valuations are also very high right now. That, in my opinion, even after such a big fall, recently should be still somewhat considered expensive. Anytime you can consider Amazon with Alibaba, compare Facebook with Tencent. Just a few examples. Some people say the Chinese big techs were in this valuation because of the Chinese government. They deserve a lower valuation because of the politics risk, the regulations. And I just believe that the Chinese government throughout last year were trying their best to press down the valuation of these Chinese companies to prevent systematic risk. So at least the most comforting thing to know is that these companies are already lying down on the floor. The gravity already did most of the job last year. So even though the US market falls, they have limited room to fall. They might fall with it, but limited room. Like Tencent today dropped 0.07%. Alibaba dropped 1.3%. So this is why I kept warning about the FANG, because I really know quite some people that couldn't take it anymore and switched to the FANG stocks at the peak. Like Amazon, for example, even after such fall, the PE ratio is still 54. It's not considered cheap. And sure, you can say that because they are the big techs, they are the future, right? They define the future. Also, they have such high growth. Sure, there is no doubt they are big tech, they are the future, but so were for decades ago oil companies, for example. Decades ago, it was also shaping the future, right? Auto company, like when the manufacturing line just got invented for cars, and like GE, for example, they make great invention, is that at some point in history, they were also worth very high valuation. Maybe the most expensive companies in the world, because they shaped the future. And it was true until they become an infrastructure. The valuation becomes much less because it has become the new norms. Then their PE suddenly dropped to 10 or 8 or even 5 because it's become normal necessity. Infrastructure, everyday use. So look around whether the big tech is doing this for the future. They are shaping the future, but are they becoming commodity for the future? That's just becoming a new norm. So do they always worth a PE high as 60 or 70 or 80 or sometimes even 100, 150? Is the current growth rate still sustainable once it becomes the new norm? Look around and watch out for this. I don't want to be too negative and scare people. Last time I made a video about Apple, I've got so many negative comments and blaming me for that. So I don't want to talk too much about this, but I just want to share why I'm being careful with the previous hot sector, the FANG and the chip, the big tech, etc. Another risk alert or danger sign I see is the memes, okay? This makes me more convinced that throughout the last 12 to 15 months, the institutions, the big dogs were exiting. Because from time to time, every period, every cycle, there would be a new meme stock flying in the sky, like GME in January. And then next was AMC in June. You realize that every time this meme happens, that gets the whole retail investors community excited. This is the perfect chance for the big dogs to exit the other positions, because this is a distraction for retail investors. And this creates greed, even though many of the other stocks are at loss or making bigger loss, but they're having fun with the memes. In January, what happened after GME? We saw a huge correction for growth stocks. And then in May, things started to rebound, and then AMC happened, and there were also other Wall Street bets going on, like the CLOV suddenly pumped from 6 to 28, and Wish also in June, right? Look at the sudden spike of volume. Back then, pumping from 7 to 15, right? And remember what happened to most of the growth stocks after this. By the end of June, everything fell. All the growth stocks, most of them peaked in January and had a second peak in June and July, right? And now it happened again. Look at BBIG. This is recent, okay? From January 10 to January 18. When this happened 1 to 2 weeks ago, it gave me a very bad feeling again. It reminds me all the things happened in January and in June, the meme stock pumping to get retail investors excited and greed, while they're taking the sentiment and opportunity to sell out aggressively the other stocks. So all of this is giving me more and more alert and warning, bad signs that I don't like to see. And there's one last one from today. Sorry, I have to use this result of the survey I did today. I made the Discord community make a vote on what are you doing today. Number 1, cutting losses. Number 2, buying dips. Number 3, changing position. Number 4, shorting the market. Number 5, not looking at the market anymore. And I guess number 5 was the clear winner with no doubt. I guess it's somewhat expected that we are just slowly accepting the fall, thinking that I would wait for the day to turn around. And second winner after that is number 2, buying dips. So these 2 are the significant winners by far, more than the other 3, which are next cutting losses. And the least we are doing right now is changing positions and shorting the market. What does this tell you? This makes me feel more worried. Is that you look at NIO, for example, right? 1, 2, 3, 4 days in a row, every day is dropping. Within 4 or 5 days, it had dropped, wow, 27%, near 30% of dropping in a week. Okay, and you look at the volume, okay? It's not small volume, because you see the volume had been increasing when it was dropping. Increasing volume when it was dropping. And right now, most of the retail community is not cutting losses on NIO. But with this spike of volume, if retail investors did not sell, then who were selling that's creating such a big volume? Think about it. This makes me a bit more worried, is that the institutions are selling, cutting their losses regardless of the prices, because they might know something is going to happen. And right now they want cash, they don't want stock. This is why I've given a few times warning about NIO's share price movement. It's looking very bearish, clearly on a downtrend. And back then I said NIO might go to 24, and most people did not believe it. And turned out I was still too optimistic. I said I worry that the 28 supports get tested many times. It might get broken and things would look ugly. So I suggested to set a stop loss, but I guess not many have done it. So I do think that the majority of the fall was driven by institutions cutting their losses. This is making me more worried. And NIO is just an example. Fundamental-wise, not much has changed for NIO except that the subsidies from the Chinese government are cutting, and it would affect NIO's revenue. And right now, the macro environment is not doing well for growth stocks. That's why I'm still holding the long-term part of the position of NIO. But I do want to see things more clearly before I buy the dip. Okay, that's enough scare for you today. Remember, everything I share today is just my own opinion. I have no proof, I have no solid statistic. It is out of my observation, my intuition, so nothing is solid. Do not take me as a reason for anything you do or whatever, okay? Now, that's it for today, and if you have enjoyed this video, please give me a big like and write me a great comment, and I'll see you in my next video. That's it, guys. Hope you can find my videos helpful. Make sure you subscribe to my channel and give me a big like. Thank you.